We have already covered the current assets for working capital management. Let us now get into the current liabilities. To start off, we have accounts payable or trade credit. Accounts payable is the largest single category of short-term debt, usually representing about 40% of the average corporation's current liabilities. This credit is a spontaneous source of financing in the sense that it arises from ordinary business transactions. Trade credit may be free, or it may be costly. If the seller does not offer discounts, the credit is free because there is no cost for using it. However, if discounts are available, the concept of true price arises. To illustrate the concept of true price, we have a simple example. The list price of a microchip is $100. The terms of purchasing are 2% 10 net 30. This means that if payment is made within 10 days, 2% discount from the list price will be granted. Hence, what composes the list price are $98 true price plus $2 finance charge. This is what was mentioned earlier that credit is costly if the seller offers discounts, because the discount you will not take will be considered a finance charge. To further appreciate the concepts of true price and finance charge, here are more examples. Suppose PCC Inc. buys 20 chips per day. If the company decides to take the discount, it will pay at the end of day 10 and show $19,600 of accounts payable. This was solved by multiplying 10 days, 20 chips, and $98 per chip. However, if PCC Inc. decides to delay payment until the 30th day, its trade credit will be $58,800. This was solved by multiplying 30 days, 20 chips, and $98 per chip. As you will notice for both solutions, the true price of $98 is used even for the scenario where the discount was not taken. By not taking discounts, the company can obtain additional $39,200 of trade credit. This was obtained by subtracting the accounts payable amount if the discount was taken from the accounts payable amount if the discount wasn't taken. $58,800 minus $19,600 equal to $39,200. We should note that this $39,200 is costly credit because the firm must forgo the discounts to receive it. The firm should determine if it can obtain the additional credit at a lower cost from another source like a bank. Now, we will solve to determine the cost of this additional credit. Let us try to solve the total annual purchases of the firm in both situations. First, the firm takes the discounts. 20 chips times $98 times 365 days equal to $715,400. Second situation, if the firm does not take the discount, 20 chips times $100 times 365 days equal to $730,000. Solving for the difference of the two, $730,000 minus $715,400 equal to $14,600. This $14,600 is the annual cost of the $39,200 of extra credit. To get the nominal annual cost of additional trade credit, we divide $14,600 by $39,200. This gives us 37.24%. This means that if PCC Inc. lets go of the discount and uses credit for 30 days, we are at 37.24% nominal annual cost of trade credit. If PCC Inc. can borrow from its bank or some other source for less than 37.24%, it should take the discount and use only 10 days of trade credit instead. Let us now proceed to the discussion on bank loans. Bank loans are an important source of short-term financing for businesses and individuals. It has three key features: the promissory note, the line of credit, and the revolving credit agreement. The promissory note spells out the terms of a bank loan. Details such as the amount, maturity, interest rate, frequency of interest payments, and etc. are found in this document. The line of credit is an agreement between a bank and a borrower, indicating the maximum amount of credit the bank will extend to the borrower. This is usually an informal and non-binding agreement. On the other hand, revolving credit agreement is a formal line of credit. Its differences from an informal line of credit are the following. The bank has a legal obligation to honor the revolving credit agreement, and the bank receives a commitment fee from the borrower. Next, we will now discuss commercial paper. Commercial paper is a promissory note issued by a large, strong firm, most often a financial institution that wants to borrow on a short-term basis. Commercial paper is sold primarily to other business firms, insurance companies, pension funds, money market mutual funds, and banks. We are now on to our last subtopic under current liabilities, the accruals or accrued liabilities. As we already know, firms generally pay employees on a weekly, bi-weekly, or monthly basis. The same practice goes for a firm's income taxes, employee benefits withheld, and others. Therefore, the balance sheet typically shows some accrued wages and taxes, which we refer to as accruals. Firms use all the accruals they can, but they have little control over their levels. On the use of security in short-term financing. Other things held constant, borrowers prefer to use unsecured short-term debt because the bookkeeping costs associated with secured loans are high. However, firms may find that they can borrow only if they put up collateral to protect the lender or that securing the loan enables them to borrow at a lower rate. Most secured short-term business loans use accounts receivable and inventories as collateral. That's it for my report. I hope you learned a lot from our videos about working capital management. You may contact us at our email addresses as you can see in the video. Thanks for watching.